Hi, I'm Christine Benz from Morningstar.com. Index funds have been gaining market share at the expense of actively managed products for the past several years. Joining me to discuss what the data say about active versus passive fund performance, as well as how investors might hold the two together in portfolios, is an all-star roster of thought leaders at Morningstar. Russ Kinnel is here from Morningstar. He's Director of Fund Research for Morningstar, and he also heads up the Morningstar Fund Investor newsletter. Ben Johnson is also here. He's Director of Global Exchange Traded Fund Research for Morningstar. Last but not least, John Rekenthaler is here. He's Vice President of Research for Morningstar. So thank you all for joining us today. This is a really important topic, and we're really excited to hear your thoughts.
Glad to be here.
Let's start by talking about what we've seen in terms of fund flows. We've really seen tremendous flows going to passively managed products, both traditional index funds as well as exchange-traded funds. I'd like the panel's views on why investors seem to be preferring index products. Russ?
I think you're right that we really are looking at a more than 10-year trend of passive funds just continuing to gain steam. And I think it's partly that we've seen star managers come and go. I think people didn't like how some active funds were in bear markets. And I think another part of it is it used to be the only people who were profiting from indexing were Vanguard fund holders. But then ETFs came out, and all of a sudden fund companies and advisors had ways to attach their own fees to indexing, and they could profit. And so now you see a lot more press, a lot more coverage, a lot more advertising around index funds. So that's another part of it too, is that ironically, the addition of fees to indexing has led to greater popularity of indexing.
Ben, I'd like your take on advisors' role in all of this. To what extent do you think advisors, to some extent, changing their business models has driven these flows into passively managed products?
Yeah, I don't think you could underemphasize just how much the change in advisors' economics has influenced this trend. So when you think about the all-in cost of advice, what you're seeing is sort of a squeezing of the balloon. So as we move from transaction-driven models and advice channels to fee-based advisory models, what you're seeing is transactions, the costs of the individual products are getting squeezed. You're seeing those costs, those expenses manifest themselves in a fee based on assets under management typically. So what that has done is it's driven down the cost of the advisor's toolkit. They're looking for lower and lower cost implements all the time, and that has benefited disproportionately index funds and exchange traded funds.
So you basically have advisors saying, if there's only a fixed fee pie to go around, I want to make sure that I can get my piece and deliver the services I need to for my clients. So whatever the cheapest products are that we can use to populate the portfolios, that's what I want to use.
That's absolutely the case. And I think also is what you're seeing is an evolution in terms of how advisors think about their value proposition. I think they're thinking more and more about ancillary services, estate planning, tax planning. They're thinking more holistically about their relationships with their end clients, and the advice, the investment management component of that is becoming increasingly sort of systematic and is being driven with an emphasis on, again, minimizing the cost of the underlying implements and capturing value through all of these other value-added services, and not necessarily security selection, fund selection, or asset allocation, which are becoming increasingly commodified.
Okay. John, when you look at these flows that we've seen into passively managed products, to what extent do you think investors are responding maybe to performance? That when you look at actively managed funds, Russ mentioned there are a lot of casualties, former star managers who have turned out to not be what maybe investors expected them to be.
To a very large extent. I mean, we've known mutual fund investors have always responded to performance. It used to be active managers that had better numbers being selected over active managers who had worse numbers, and that's how Fidelity became the largest fund company in the world at the time, and how traditionally how fund companies succeeded is by having actively run funds that had better numbers. Before Morningstar ever existed with performance numbers and star ratings and so forth, investors were still buying. If you look, they've always bought on generally speaking, on long-term numbers. And index funds, in particular in large company U.S., which is the starting point for index funds, where most of the assets are and the most visible part of index funds, they've done very well, particularly in 2008. 2008 was huge for indexing because index funds kept pace with active managers in the big downturn, which is when people thought active managers would be their relative time to shine. So that was just the trend was already moving strongly toward index funds, but I think had 2008 played out differently, we could have seen the passive trend not completely stopped, but much slowed. Instead, it accelerated it.
So they didn't deliver in the clutch.
The active managers didn't deliver in the clutch. At least that's how people perceive things, and that's how the story's told, and that's where the assets are going.
I do think it's a little unusual. There's kind of a footnote to 2008 in that in equities, passive did just about as worse as active. So you really didn't get a lot of benefit. So it wasn't a standout either. It was in bonds where passive did much better than active. Yet what happened out of that was money rushed into active bond funds and passive equity funds. And it's continued to do that largely to this day. And yet, if it was really a performance story, what it should have been was people would have been all over passive bond funds after 2008, and equities wouldn't have really changed very much because the passive equity funds did just as poorly as active.
Yes, there are some quirks in the performance story. It generally holds true, but that's obviously one, and there are others.
So what is going on in fixed income, Russ, in terms of the flows there? Why, despite that really good return from the Barclays Aggregate Index in 2008, why do investors continue to prefer active products there?
Well, they did perform better coming out after 2008, so because they tend to have greater credit risk, et cetera. So I think that's part of it. You had Bill Gross and Jeffrey Gundlach as bond stars. If some of the equity stars were diminished, theirs were enhanced by what happened in 2008, 2009. So I think that's part of it. But also I think people are just inclined to be passive with equities and not with bonds. So I can't completely explain it.
I want to follow up specifically on bonds and bond index construction. But Ben, before we leave the flows topic, I'd like to talk about what types of funds investors are tending to prefer when they're buying passively managed products. Where are we seeing the flows going?
Yeah, so I think as much airtime is given to more exotic fare, what we see is most of investors' capital, where it resides now, and at the margin where it's going, is going to vanilla stuff. Very broad-based benchmarks that are investable at an extremely low cost. That still accounts for the vast majority of all assets, all incremental flows into index funds, be they traditional open-ended mutual funds or be they ETFs. So again, I think what you see in the headlines, what you see in some of, Russ alluded to, the proliferation of advertising. If anybody watches CNBC, I don't, I can't bear to watch it, but you watch CNBC anymore, 3 out of 4 commercial spots are for some newfangled exotic ETF exposure. That's not where investors are putting their money. They're putting their money on low-cost, plain vanilla passive.
So total stock, total international stock, total bond is really where we're seeing the flows
Absolutely.
go. Okay. Russ, are there any areas of active management, even though overall the trend is strongly toward passively managed products, any areas of active management? You alluded to the fact that active bond funds have been doing a pretty good job of attracting investor assets. Are there any other spots where investors appear to be more comfortable sticking with actively managed products? For
sure. So not just core bond funds, but really the whole array of bond funds, bank loan, high yield. We've seen almost all of that, is going to active funds, but also foreign equities, both broadly diversified as well as emerging markets. Most of that money is going into active, though there are some strong flows into some passive foreign as well. But it seems like outside of U.S. core equities, you see much more interest in active funds in general.
Of course, it's hard to generalize about why investors might be doing what they're doing, but does anyone have any thoughts about why investors seem to prefer active products in the international space?
Well, I think one thing is in international, you've long had a overweighting in Japan, in the indexes, at least relative to passive, or to active. So Japan peaked around 1990 and since then has mostly lagged the other markets, and so active managers have consistently or pretty consistently added value by avoiding Japan. They tend to have more in emerging markets, so they tend to have better returns.
See, it is about performance, Russ.
Fair enough.
Get back to in this case. The foreign large blend active funds as a whole have outperformed the passive funds. So, I mean, people do pay attention to performance.
Yeah.
We can talk about why that is, or he is talking about why that is, but that's, yes, it's performance related, as well as habit, because as I said before, people started with U.S. large cap S&P 500 as the first index. That just seems the most logical and comfortable place to them, and the numbers are also supporting that as well. So you've got performance and history working together. The performance and history are not as strong on the foreign side, and that's why the active managers are still receiving lots of money.
Okay. So before we leave the flows topic, Ben, I'd like your take on whether this is really an ETF story or have, in fact, we seen flows go to the traditional index mutual funds as well?
It's really been both. I would say the flows into traditional funds have been dominated by retail investors. I think if you look at the availability, given that ETFs are by definition traded on exchange, and the number of different use cases. So if I'm buying an S&P 500 ETF, I'm not necessarily using that as a core long-term building block. I might be a market maker that's keeping that in inventory to hedge my exposures as I'm making markets in ETF shares. I might be using that more tactically to hedge some sort of exposure. I might be selling it short. So if anything, ETFs have benefited marginally more, have seen additional flows only because I think the potential user base from individuals to institutions and the potential number of uses is greater relative to a traditional fund.
So the short-term investor can find a home there, as can the long-term investor.
Absolutely.
Okay. So let's look at performance. We've alluded to performance of active versus passive funds in various categories. But first I would like to discuss why making an assessment about whether active management in a given area is good or bad, why that's difficult to do. What are some of the impediments and what are some of the reasons? Maybe just to use a simple example, why shouldn't I go on Morningstar.com, look at the typical large blend funds return and compare it to, say, some sort of total market index? What are the drawbacks to sort of a very simplistic assessment like that, John?
Well, there's a couple issues with performance measurement. One is that the conclusion that you draw will differ depending upon the category, the area that you're looking at. For example, just have some numbers now, and if you adjust for cost, so you just say, okay, I'll take funds with the same cost structure, so we'll eliminate the cost advantage index funds have. On the large blend side, over really all the trailing time periods, the passive funds have still beaten the active funds, as well as in small blends. So both large and small cap US, for the same cost, the passive funds have beaten the average active fund. But you look into the foreign large blend funds, the opposite is true, and you look into the intermediate term bond funds, the opposite is true. So four groups that have kind of major indexing groups, and it's split, it's 2 versus 2. Now, you're always better off buying the cheaper funds. So we need to start, there are some expensive index funds, they're not good either, and there are a lot of expensive and overpriced active funds. Don't want those. But when you get to lower cost funds or funds level the playing field on cost, the evidence is mixed. And why is it mixed? Well, now we can talk for a long time because it generally has to do with some sort of difference in construction between what the active manager, the pool of active managers, and what the benchmark is. We talked on the bond side that the aggregates got more in treasuries. Internationally, there's
more Japan,
and you go through the list, and they're all differences. So it's tricky to generalize because it ends up being, not so much this group of managers happens to be particularly bright, and this group is particularly dim, but they're doing somewhat different things, and you need to decide do I want to do that different thing or not?
So I think fixed income is probably the perfect example of what you're talking about, John. Let's talk about how the Barclays Aggregate Index looks pretty different from the typical intermediate term bond fund, why that is, what sort of choices the active managers are making there. Ben, let's talk about that.
Yeah, so I think if you look at the Barclays Ag as it stands today, it looks very different from its peers. So Barclays Ag Index funds are grouped into our intermediate term bond category. And it looks fundamentally different because it leaves out what has been a very significant and very well-performing portion of that opportunity set that's available to active managers who aren't just trying to hew to that benchmark, which in general terms has been credit. So if you look at the average manager in the intermediate term bond category, they've been feasting on credit over the course of the past few years.
So corporate bonds.
Corporate bonds, anything with more credit exposure than you might face relative to something issued by the U.S. government.
Right.
You look at the ag and it's very heavy on either securities that are either directly issued by the U.S. Treasury or have some sort of implicit backing from the U.S. government. So that has really disproportionately benefited, at least in hindsight, active managers in the intermediate bond space because they have an active mandate. They can go virtually wherever they'd like, depending on what their process is, what their actual mandate might be, whereas the index funds have to hew to the index. Now, if you look at the ag and widen out the ag, so if you look at the Barclays U.S. Universal Index, which tacks on a portion of that credit pool where active managers have been playing, it's been a much higher hurdle for that same category. So from an investor's point of view and an index investor's point of view, that's fared relatively favorably. Of course, we're talking about sort of the since 2008, 2009 portion of this cycle. Things are going to look fundamentally different the next time we go through a downturn, whereby it's not going to pay to necessarily have that credit exposure the next time global markets hit the skids. So it's important, I think, more than anything as an index investor to understand the benchmark, because there's a process underlying that benchmark. And does that benchmark adequately reflect the opportunity set, the constraints that might exist on active managers? Where it does reflect that opportunity set, it's going to be more difficult to beat. Where it's either narrower or sort of more, sort of concentrated in certain cases, something like the MSCI EFA, it's going to be easier to beat because by virtue of omission, I can say, Japan's not my taste right now. I'm going to sidestep these things, and it represents a very heterogeneous group of exposures, of countries, of sectors, et cetera. So understanding the benchmark is absolutely vital.
One of the biggest advantages that active managers can deliver is not what they buy, but what they avoid. Mm-hmm. Yeah. And we've seen that several times in the past where active managers have fared the best is when an index will have a chunk, as in Japan or as in technology stocks, yeah. A chunk of something that tends to be highly priced in the headlines a lot, mm-hmm. and active managers are saying, I don't want to make that complete bet. And that's when they've done well. Yeah. But if you don't have an index, if the index doesn't have those opportunities in it, that makes it harder. It's harder for active managers to, security by security. At least it's hard to identify those managers ahead of time, security by security, to be beating it.
Yeah, and in the bond world, I think it's also kind of a portfolio planning idea too. Okay, this index fund is giving me almost all government exposure. Some of these active funds are giving me something very different, and so part of it is just understanding, well, what kind of exposure do I want there? A lot of the active funds have huge toolkits. This year, PIMCO Total Return is ahead of the group because they bet on the dollar, rising dollar. Double Line has historically made a lot of hay by investing in mortgages, even private mortgages. Funds make all sorts of derivative bets on, say, yield curve moves, sector moves. So you've got, on the one hand, a really wide-ranging toolkit, and on the other hand, with passive, a very government-heavy high quality, but with some interest rate risk. And so really you've got two fairly different things together in the same category.
I think that's a really interesting point, Russ. And I guess, when you sort of look at the fact that investors appear to be preferring active funds and fixed income, are they perhaps overlooking the fact that Barclays Aggregate Index might be pretty narrow, but it sure did come through in the clutch?
It's the better hedge in an equity downturn. I think you could never say that with absolute certainty because each downturn has different has different characteristics, and the correlations that happened last time won't exactly match. But it's a pretty good bet that the Barclays is going to be a good hedge against a stock market downturn and better than most of the actively run funds because of that treasury component.
Okay.
Yeah. So it comes down to portfolio role. Is it more important for me for this to be a hedge during that downturn, or more important for me to make a little more money in this area over a 5 or 10 year period? You're probably going to get more total return when you have the active funds that have the more credits in there, but it'll sting a little bit.
It's important to have that context too, right? We're not talking about selecting funds, selecting benchmarks in isolation, but to take a step back and think about the overall asset allocation and what does that yield in the context of the overall portfolio and the risk and return profile thereof.
And if I can push a point just slightly further, if you think about those roles, you say, okay, if this is really about correlations and hedging, I'm going to move toward more treasury heavy. If I'm willing to live with a little bit more pain in the downturn than the active funds, and if I'm really not that concerned with it, you might not own that bond fund at all, which is more the way I go, which I'm not advising everybody to do, but I'm not the only one who's made that. There's, Bill Bernstein, some others. I mean, at any rate, you want to think about the role that these things have, and that will end up informing your active passive decision often.
Yeah. And how big is your fixed income as part of your overall portfolio? If it's 50% of your portfolio, then I want the bar cap. I want some of these more aggressive managers. I'm going to want probably some foreign bonds, maybe some high yield. Maybe I'm going to want tips for sure. I'm going to want a really broad array of a diversified bond portfolio. If it's 10%, then that diversification is a little less important.
So we've talked about it's really crucial before you make these active versus passive performance comparisons, understand how the index may be different from the universe of active funds that you're looking at. I'd like to also talk about time period, how that matters and how that informs some of these trailing returns that we might look at. So one thing I've heard loud and clear is that in a really robust market environment for the stuff that's in the index fund will be the winner. So let's talk a little bit more about how time period plays a role here. And Ben, maybe you can hop on this, talk about how looking at equity passive products today, they may look a little stronger due to the fact that we've had such a strong equity market.
Yeah, and I think it's important to go back further yet. And I think the longer you look back, the more the case for index exposure is galvanized, looking across full market cycles. And let's not conflate that necessarily, with passive so much as I think first and foremost it's a matter of cost. And when I talk to the topic of cost, you've got to think more holistically and think also beyond the headline expense ratio. Think of all of the other implicit costs of day-to-day portfolio management. And when you look at, say, a total U.S. stock market index, the annual turnover in that index is 3 to 5%. And there's a real cost to turnover in terms of brokerage commissions. In the context of an active manager, every time you're turning over your portfolio, you're making a call. So you're saying, I have conviction in this, whether I'm buying or selling. So not only are there those explicit costs, but there's the implicit cost of potentially being right or wrong. So the higher your turnover, the more you're incurring both those explicit and implicit costs. So long periods of time show that low costs be it the explicit fees, be it portfolio turnover,
Taxes.
what have you, taxes, absolutely critical, especially in the context of where we're at in the current market cycle, where everybody's sort of drawn down their deferred tax assets and now they're spitting out big capital gains. These all add up over time. So it's not passive so much as that passive implies low costs in the form of low fees, low turnover, and less of a tax drag, less of a tax headwind. So passive just has shorter hurdles ahead of it than many active managers who of their own doing often create for themselves.
So Russ, I know that you have written and worked a lot on this issue. In fact, it's your view that it's not active or passive, it's low cost versus high cost, and you can find some low cost active funds.
Right. I think when you look at a really well-run, low-cost active fund, now you're talking about a fund that's maybe charging 40 or 50 basis points versus the index charging 15 or 20. Now you've got a much lower hurdle and often very good funds. You look at some of Vanguard's actively managed funds, and these are outstanding values where they only have to beat that hurdle by a small amount. So I do think, yeah, you want low cost in either case. John wrote a column about a year ago where he looked at the biggest funds from a decade ago and found that those active funds did quite well too, because nearly all of them are low cost, because the big funds tend to be low cost. So yeah, I think if you get your plan right and you're a patient investor and you buy low cost, well-run funds, you're going to do well, whether that's mostly active or mostly passive.
Okay. So Ben, you have been keeping tabs on data about active versus passive performance over various time periods. And I think we've alluded to some of the conclusions so far. So large cap blend funds versus, say, a total market index over almost any trailing period, as John said, not super overwhelming in terms of performance. The active funds haven't done very well. Foreign funds have done relatively better. Is that what your data would indicate?
Yeah, so I think what we've seen is what others have already documented in other research that's been conducted is in more efficient markets, such as U.S. large caps, it's more difficult, and I would argue probably getting more difficult by the day to add value, to outperform. If you look at other markets, depending on how you measure it, whether relative to benchmark, whether relative to passive investable alternatives, for all the reasons we discussed earlier, your odds are more favorable in terms of outperforming either a passive option or a category relevant benchmark. Fixed income is another area, for reasons we discussed earlier, that the odds have generally been more favorable for investors in terms of being able to select market-beating, passive alternative-beating options. A lot of that has to do with the construction of bond benchmarks. A lot of that has to do with just the nature of bond markets. Bonds are not stocks. So it's a different set of use cases. It's a different set of criteria. It's a different set of investors relative to stock markets. So what I would say uniformly, what we see across the data that we've looked at, again, is that it underscores the importance of cost first and foremost. So as you separate performance by cost quartiles and look at the lowest cost fourth of funds across virtually all categories, your odds improve materially as you shop for less and less expensive funds. And that's as defined not only by the headline expense ratio, but also by turnover as well, which yields implicit, explicit costs and tax costs as well.
Yeah, Vanguard's passive equity funds and its active equity funds have had similar aggregate long-term returns because the active funds are cheap.
Okay.
So it's, yeah, I mean, that is the bigger consider. We're all saying the same thing, but it really is true. It gets, and this is passive versus active. We're kind of framed it this way, but really it's low cost versus high cost.
Right.
That's what it ends up being.
Right. So the data on this will tend to swing around based on time period, based on composition of active portfolios. But I'd like the panel's take on the question, are there any areas where you would say absolutely always index this area? And also the flip side, any areas where you would say never index, it doesn't make sense? Russ, how about that?
Well, there are some areas where there's not a lot of index options. So high yield, emerging market debt, munis. There's there are a few funds out there, but not a lot. But in general, no, I don't feel like I think I like to use index funds to lower my overall portfolio cost, to free up some of the active managers. If I've got broad index funds in my portfolio, then I don't have to worry about having all of my active funds fit in perfectly together. I've got some room. I think it's strange that people completely write off large cap US actively managed funds when you look at how many really good ones there are. I own a couple of prime cap funds that are in that space. They're outstanding funds. I don't know why I would want to sell them. Sequoia is now closed, but that's another great one. Oakmark Select, Vanguard Dividend Growth. There's so many good ones. I don't know why you'd want to rule them out. So I think for me, it's more about get really broad, lower your costs, and then pick your active funds where you find really good ones.
Ben, what's your take on that question? Any areas where you would say always index or never index?
I think if you look at U.S. large caps, I won't say always index, but I would say the odds certainly, based on all of the data that we've seen, and I think increasingly on a go-forward basis, these markets have become hyper-competitive at this point. You know, there's now in excess of 100,000 CFAs globally. We have all got, or will soon have, Apple devices on our wrists. The informational efficiency, the degree of competition for outperformance, for alpha, in something as broad and liquid as U.S. equities is only going to grow over time, which means that everyone's more skilled. The distribution around sort of average performance is going to get narrower and narrower. So the benefits for selecting a good manager are going to be less. Conversely, the benefits for selecting a crummy manager going to also be less painful, I would expect over time. But I think U.S. large caps, in general, I would focus the majority of that sleeve to a benchmark, and then think about carving out an allocation to a high conviction active manager. I think Russ has provided some great examples there.
A follow-up question, Ben. You made me think that, and we've written and talked about this before, but this issue of increasing flows toward passive, is that potentially going to create opportunities for active managers? So we get back to maybe the tech stock mania, for example. All the indexes are sort of blindly buying these companies. That was actually a great opportunity for value-oriented managers. Would we see potentially that sort of phenomenon occur again in the future?
Yeah, so I don't want to draw the conclusion that indexing is necessarily changing market movements. I think we're in a macro-driven world right now where QE has become dinner table conversation for a large segment of the population. So markets have been whipsawed by Fed speak, not necessarily by ETFs. ETFs, index funds, are just looking to track the benchmark. So I think what creates opportunities for active managers is not correlations amongst components of the equity market. It's dispersion. So the biggest gainer and the biggest loser, how wide's the difference between that? Because as an active manager, that reflects my opportunity, my capacity to outperform by either avoiding really big losers or buying really big winners. When that's narrower, as we saw last year, 2014 was a prime case of this, that dispersion was extremely narrow, and active managers had a terrible year because that opportunity set was very narrow. So it's dispersion that creates opportunities, but you also can't jump to the conclusion that active managers are always going to capitalize on those opportunities. Some will, some won't, and the wider it is, the wider the differential in their performance. So it's difficult to say.
John, you have something to say on this topic.
I'm waiting because I'm ready to say always and never.
Always?
Well, okay, that's just, I have to slightly asterisk this because, fairly close to always and fairly close to never.
Okay.
We'll go there.
Always index?
Okay, so, I'm going to start with never, which is hedged never. But as a general, if I were looking, I don't index, or I don't buy sector funds and country funds and narrow funds, but if I did, I would be reluctant to buy an index fund because the construction of the indexes, when you get into single countries, unless it's a really big diverse country, or sectors or whatever it is, infrastructure or, just narrow chunks of marketplace, that has some strange properties.
You get some weird indexes with high concentration.
I've seen indexes with 18%, 22%,
Yeah.
The Finnish stock market, Nokia and such.
Canada
So
with
I would look for a respected, good quality fund company offering an active fund at a reasonable cost, and I would, even if that didn't have much of a track record, I would bet on that than I would bet on over an index. And I would think that the odds are good that if that particular segment of the market is, one segment of that concentrated market is acting peculiarly, that the manager's going to lower risk by avoiding that.
Okay.
So in terms, so that's the almost never index. On almost always index, I would just say always index, and somewhat in contrast to Russ. On large cap U.S. in a taxable account, the odds of identifying a fund ahead of time and taking taxes into consideration, there's probably a handful of low turnover large cap managers that still at a low cost, who are active, who are competitive. It's a small number. I mean, it's. I think for most people, the argument is pretty simple, just to go out there and index. Or you can buy some Berkshire Hathaway B shares. That's like a big mutual fund at a low cost too.
So I want to follow up on this tax efficiency point. We could spend a lot of time here, but I think when you look at the data, if someone is within a taxable account, that there are strong advantages to being in some sort of a passive product. To what extent should other sort of personal characteristics, my tax position, but maybe just more sort of personality characteristics inform whether my portfolio is majority active or majority passive? Russ, I know you have some thoughts on that.
Well, I mean, one simple way is you think about one thing passive funds do is they give you time. It doesn't take as much time to research them. Not a lot changes. So if you're someone who doesn't have enough time, or you tend to make changes because some big event has happened, maybe you haven't been paying attention to your investments for a couple of years. Now something big has happened, either a macro event or the manager's left, and you kind of panic and make a bunch of changes, then maybe passive is better for you. I think in either case you need to be patient. With active, it requires maybe another level of patience, because you have to understand that there's going to be times when you'll lag the benchmark, when you'll be out of favor. You really need to hold that fund for the long term. So I would say that's maybe a little diagnostic of the personality that's best fit for active.
The best active funds will tend to look really bad at certain points.
That's right. We talked about star managers, and one of my pet peeves is that we've seen funds like the former Legg Mason Value under Bill Miller and others lionized for beating the benchmark every year. And people then think, well, that's what I want an active manager to do. They're somehow going to miraculously outthink the markets every single year. And
on an arbitrary calendar, where why not do June to June? That's fiscal year.
And that's setting you up for tremendous failure. That's not what active managers can do well. It's much more about finding good values that over time pay off. And so you really do need to be a patient investor and have the right expectations going in. You can't think this manager's got to do well every year. Or we talked about 2008. One of the things some people said was, well, this manager should have gone to cash, or they should have gone into bonds. And yet that was even for funds where the fund always was in equities. Maybe its prospectus didn't say it would go into cash. So you have to be realistic as well and understand here's what the manager will do and what they won't do before you buy the fund. Look at the fund's calendar year returns, understand what you're getting into ahead of time.
So investors often compound their problems with active funds too by buying them after they've had one of those great performance runs.
That's right. Another part of that is you have to be a rational thinker who can keep contributing even in the downturn and not just go after the hot fund that had a good single year, or again, you're just setting yourself up for failure.
One thing I wanted to touch on regarding performance, we have our investor return statistics where we can look at dollar-weighted returns, see how the typical investor in a given fund has done. What do the data show when we look at active versus passive products? Do passive investors tend to do better from that standpoint?
A little better. It kind of depends how you look at it, but in general, a little better. We talked about time period. It's a very time period dependent measurement because
investor returns.
Investor returns are because you can have, say, an event that happened 10 years ago, maybe a lot of money came in, or maybe when we look at some share classes, maybe a new share class was created, and that can throw the data off. So I'm cautious about reading too much into it, but I think over the long haul we'll find that they do a little better because they tend to invest consistently.
Let me touch on investor returns. So investor returns, right, is the attempt to measure how investors are doing in funds. Are they making wise investment decisions, and separating that out from the standard fund returns, which are calculated no matter what dollars are in there.
Right.
So if you look at investor returns now, they tend to look quite good for passive funds. Why is that? Well, there's been a lot of money that have come into passive funds over the last 5 to 6 years, and the stock market's been up a lot, and come into stock funds. So I'm speaking about, say, U.S. stock funds right now. So the money has come in. This new money has never known a down year if it came in after 2008. It's done well. The investors look smart. But about our passive, setting aside maybe the funds that they're buying are good funds, but setting that aside, are passive investors smart in the sense of a market call? No, it just happens that the people that are buying into the market in the last few years have decided to invest passively rather than actively. If we have a big downturn next year and the market drops 25%, then all of a sudden the passive investor returns are going to look not any as good, maybe even fall behind the active investor returns, because a lot of money has come in recently. I don't think that makes so. So when you're interpreting these numbers, it's just difficult to. We keep talking about how much work it is for people, but it is. You look and you draw a simple conclusion. Okay, passive. The passive investor return numbers are good right now. Passive investors are making much smarter kind of asset allocation decisions. Well, the next year in a different market, the numbers tell you something different. It's easy to arrive at a simple conclusion, but it doesn't mean it's a correct simple conclusion.
Right.
There are many ways of getting at an incorrect simple conclusion.
Well, and can we cut through, because I completely agree that there are flaws with these numbers. It's important not to take them at face value, but Russ touched on the topic of expectations before. So intuitively, an investor in an actively managed strategy comes with the expectation of outperformance over some period of time. An investor in an index fund expects market performance. Right. So to the extent that could potentially drive relatively better behavior, as it were,
I agree.
I think there's some intuition there. I'm not necessarily relying on the numbers.
I think passive funds are easier to own. I think investors, as a general rule, investors will have a better investor experience as we define it, which is the gap between investor returns and the standard returns. They will have a better experience in general with passive funds, because it gives them fewer reasons to make a bad decision. They give them fewer reasons. But there are those who, I think it really, active funds are, if somebody is liable to make quick decisions based on short-term data, buy passive funds and avoid that temptation. That's the temptation that will lead you down to a hot place somewhere down there. If you're an investor, you don't want to go there.
But those same people probably aren't willing to settle for market returns at a low cost and watching paint dry.
No, what they're doing is they're buying your new ETFs that you watch on the CNBC.
That's right.
Well, you get the best of both worlds. It's active passive.
Maybe the most active investors out there are the people who are buying niche ETFs and trading them every 6 months.
You don't get any more active than that.
It's funny, right? That's far more active than, say, buying a active fund that's got 10% turnover and holding it. So. Yeah, that's the worst of both worlds.
I just was talking to our colleague Tim Strauss about where the flows are going in terms of ETFs, and the hedged international funds are seeing huge flows. So maybe an illustration of what Russ is talking about.
Yeah.
Okay, so I want to talk a little bit about a fund type that's kind of a hybrid, these strategic beta products. Ben, maybe we can start by you just defining what strategic beta, sometimes called smart beta, what the heck that means.
Yeah, I mean, what you're seeing really is an evolution in index construction. So the Dow Jones Industrial Average, the Bar Cap Ag, they were designed to be printed across the masthead of the Wall Street Journal. They were designed as a broad barometer to gauge the performance of a big sloshing bucket of securities. What you see in strategic beta is the emergence of indexes as an investment strategy. that combine elements of active investing. So all of these involve some sort of active bet relative to a broad market cap weighted exposure, while trying to retain many of the benefits of passive investing. So they tend to be relatively low cost. They tend to be transparent, rules based. All in all, most of these look to exploit some sort of factor or some sort of return.
Let's talk about some of the examples of the factors.
The factors are factors that have been documented for years and years and years in academia. They're factors that people have been trying to exploit for years and years and years in asset management. What we're talking about is old wine in new bottles. DFA has been doing factor investing now for decades. Bar Rosenberg, founder of Barra Associates, was talking about his bionic betas in the mid-1970s, around the time the first index fund was launched. So this is nothing new.
So we're talking about value.
So we've gone from strong betas to smart betas.
To bionic to smart to strategic to
oh yeah, that's right. Smart, I forgot about that. Right. Go ahead.
Any name you'd like, I prefer strategic, because it represents an investment strategy. So I'm looking to isolate value. I'm looking to isolate maybe some sort of size premium. I'm looking to isolate dividend income. Momentum. Quality. Liquidity. It's grown exponentially, and now they're being recombined in multi-factor exposures. So it's old wine. It's these old factors that we all know well, that have been documented, that have been exploited before, but in new bottles in an ETF package that's traded on exchange, that's broadly available.
Important to also mention that this is what active managers, these are the kinds of things active managers historically have done. So now you have so-called passive, I mean, they're passive in a way, but actively built, but passively run maybe. Passive funds competing by doing what active managers used to be, only their territory. And you know, back in the day, if you were an active manager and you just, you had some value and momentum exposure, maybe not even
there are still funds that do that.
Maybe not even consciously thinking of it that way. Just you bought companies that had those attributes. You probably had above market returns. You got a lot of money. You were a great active manager, and now that can be possibly, in some cases, fully duplicated through a mechanical strategy.
Right. I love how it raises the bar on active management.
It does.
So you can look at, you mentioned equity income. So there are equity income indexes and equity income funds, and you can say, okay, but let's look at that passive fund or the passive index and compare equity income funds and see which ones meet this higher bar. There's dividend appreciation. Vanguard's got a fund for that. There's some momentum. So what I really like is they raise the bar. It's a little easier to see which ones are really adding value. But it also means you've got this fallback option of, okay, I've got this lower cost passive version, and particularly for, say, a dividend fund, that means more of those dividends are flowing through to me. So I think they're over-marketed, but there's also some really good value, some really good ideas in those.
It's great. It's great competitive pressure on the active funds, because now you've got something out there at half or less, third, quarter of the cost, that is overlapping a lot with some of these manager strategies.
So if you've got an active fund that's using some really mechanistic strategy, the fact that there's this index with a very low price tag attached to it, potentially
it's even more than that. It might not be a mechanistic strategy, but it might be that the idiosyncratic bets that they make balance out. Some work, some don't. So what you end up with is a mechanistic return minus the cost.
Right.
And you might as well get a mechanistic return minus a lower cost, and also a more easier to research, more predictable fund through an ETF. So these are a second wave of challenges for active managers.
And I would say the incremental idiosyncratic risk that is something like just manager risk and key person risk and personnel risk at an active shop as well. So you eliminate that element in addition to offering it at a very low cost. And we see some examples where you look at the strategic beta TAC, you look at an active strategy, and the performance differential in certain cases is exactly equal to the difference in the headline fee. So it's just a lower hurdle for a very comparable strategy.
That said, since we're being nice to strategic beta, to be unnice, I don't think people are going to use these well. No. I think that people are going to, they're instead of being used strategically as a long-term, 10 or 15-year long-term portion of the portfolio, they're going to go in and use these things kind of like sector funds and do what the mistakes people traditionally made with funds and buy what's performed well and the strategic betas that have done well recently and sell the other ones. So that I would be surprised, especially when you look at the more specialized funds, that if they end up really making money for people, even though they're well constructed in many ways. And we said the positives. That's
and you already see that in terms of how investors are selecting these funds. So if you look at the U.S. universe of strategic beta ETPs, what we see is a pattern of behavior whereby 80 to 90% of the assets, 80 to 90% of the incremental flows are going into those funds with a Morningstar rating, a star rating of 4 or 5 stars.
Which means that the past performance has been strong, right? That's how the star ratings. Just to be clear, it's nobody's opinion. It's just the numbers have been strong numbers.
So I would expect, to your point, John, that in all likelihood they will use them every bit as badly as they have active managers.
Right, because of course the academic research underpinning all of these generally would tell you to do the opposite, to buy momentum after it's done poorly, and so yeah, I think that this first we do have this sort of immature phase for a few years in which they'll be used badly. They don't have to be used badly.
No.
I like some of the low volatility strategies, some of the dividend strategies, especially when they come with the Vanguard brand expense ratio. And so I think there are some appealing ones, but unfortunately not everyone is using them correctly.
Well, and I think much like as you alluded to earlier, Russ, with active strategies, expectation setting is critical. Value pays off over the long term, but the long term is measured in tens of years and not tens of months. So it's crucial to ride through, much as with a disciplined active strategy, ride through the good and the bad and understand over the course of a full market cycle, which again is probably in excess of 10 years, that you will be compensated for that particular strategy in the form of outperformance. But as we've seen and you've documented in your Mind the Gap study, very few people are willing to ride out through those storms.
Russ, you mentioned a couple of flavors of these funds, low volatility, some of the dividend-focused funds. How do I use, if I were inclined to use one of these products, how would I use it when in the context of my portfolio? Do I use it alongside a total market index? Do I use it instead of a total market index? What's my plan there if I were inclined to use a fund like this?
You might use it instead of, or it might be a supporting player. So I think of Vanguard Global Low Volatility. I think I'm getting that right. But anyway, that one is essentially indexing the world, only it's got a currency hedge and it's got some other biases to reduce the volatility. So that one you could use as a replacement. Then others like, say, equity income or dividend appreciation you might use in addition to. And then there's some others that are more niche, like a momentum is very much one you use as a supporting player. I would hate to see someone swap out a total stock market for a momentum fund. That would not be good. So I think some of them, yes, more of them are kind of somewhere in between niche and core.
Okay. Ben, Russ mentioned a couple of Vanguard products in this area that he likes. Are there any other strategic beta products or shops that are doing strategic beta that you think are doing a particularly good job?
So I think there are 2 funds in particular that I think one could be used either as sort of a core player or specifically as a way to generate equity income. So Schwab U.S. Dividend Equity Fund charges an extremely low expense ratio, tracks a benchmark that has a very fundamentally sound methodology underlying it that isolates quality dividend payers. So dividend payers that have grown their dividends across market cycles, that haven't cut them nearly to the extent that other dividend payers have during market drawdowns, is a very high quality portfolio, is a value portfolio. That's the other bit too to understand, is that the way these things are labeled in their process and what comes out in the wash in terms of the end product, there's often a differential there. So a lot of the dividend strategies are really just value strategies with a dividend label put over the top.
A lot of strategic beta strategies are value.
Massive. It's all just small, going towards value.
Yeah, I mean, you just shake it around and you end up with a value portfolio.
Right.
Right, and that's key. You're talking about core holdings versus that, and building your portfolio. If you're buying one of these fundamental index funds, understand that it's filling the value role in your portfolio.
Right. Use our X-ray tool.
Right. Use our X-ray tool and make sure you're not taking on undesired sector bets.
Yeah. Well, and you're not paying too much for a type of exposure that you could get in a very low cost, very straightforward manner elsewhere. So why go the strategic beta route for 50 basis points to pick up a little bit of size and a little bit of value in your portfolio when you could buy Vanguard U.S. small value at a fraction of the cost in a far more straightforward, transparent way. So it's important to understand what you're really doing, not only in terms of overlap, but overlap from sort of a factor perspective too.
If you notice, what we're doing is we use the strategic beta funds and held the active managers against it and say, are you getting enough value? Now we're doing the same thing to the strategic beta funds. Hold the general funds against the more general lowest cost funds against them and say, how much difference is there, and is it worth paying extra for? So do to them what they're doing to others.
Yeah. Right.
Yeah, there are a lot of ways to skin a cat, and do I want to take the more expensive, more sort of convoluted route necessarily? I would argue that's not necessarily always the best route.
So it sounds like you had one more pick for us, though.
The other one in terms of U.S. large value, so the PowerShares FTSE RAFI 1000 follows the research affiliate's fundamental index approach, which is really a value strategy, but is a value strategy that is somewhat more volatile in that it rebalances into value really pretty aggressively during market downturns based on an assessment of company fundamentals. It's available at a very competitive price tag and has fared very well relative to strategic beta, relative to vanilla beta, and relative to active managers in the U.S. large value category.
Okay. I want to get to some specific picks within the active and index space. But before we get into, say, our favorite index funds, and we've talked about some of them, let's just tick off a few things like know before you go. So look for low costs, understand the index's construction. Anything else that investors should have in mind when they're trying to decide among index funds or decide whether index funds are right for them?
Let's see, certainly holding period is another part of that.
Your holding period or the
your holding period, so you want to align that correctly. I think you want, as you mentioned, low cost. You want to think about the taxable side. If you're buying a passive fund, maybe put that in your taxable account if you're buying it, and put the active in your tax sheltered account. Okay.
So in terms of sort of favorite index products, several have been mentioned during the course of this discussion. While we're talking about costs, I know that our ETF analysts really like a lot of the Vanguard funds specifically because they are lower cost than some of their competitors. Are there any reasons that investors might look outside of Vanguard?
I think there are a number of different reasons. Chief amongst them is choice. So Vanguard has a very concentrated lineup of ETFs, some 66 or so ETFs, which are uber low cost, broad core portfolio building blocks. If investors are looking for more nuanced exposures, if they're looking to hedge currencies, get some sort of more narrowly focused low volatility strategy, they're going to have to go outside of Vanguard to meet those needs. So there are any number of those sorts of exposures. So one that comes to mind would be iShares Emerging Market Minimum Volatility. So EEMV is the ticker, which is something Vanguard doesn't have a comparable offering. They have a broad-based FTSE Emerging Markets ETF in index fund, but certainly there's a whole host of offerings outside of Vanguard's walls that offer very useful and very competitively priced exposures.
So if for whatever reason you were inclined to slice and dice things a little more narrowly, you may have to look outside of Vanguard.
Right.
Okay. Let's talk about active products. I think we've hit on some of the reasons, some of the things you should think about before you embrace an active product. So it sounds like knowing yourself and your ability to withstand some of those periods of turbulence, knowing how your fund is positioned is obviously very important. Tax character of those assets also an important consideration. Any other things you would add to that list of things that investors should have in mind when looking among active funds?
Among active funds?
Yes.
Well, I think you want all the good characteristics you mentioned. I think good strategy. I think stability is really important. We talked about all the great benefits that stability in passive bring, but I think you look for a stable team. I like Dodge & Cox. I like PrimeCap. Some of the Wellington funds run for Vanguard. Those are firms that are tremendous stability, and that makes the funds easier to own, but also makes them better long-term bets because they're they're better designed to carry on over the years. You're not so linked to a single manager. These are firms with really strong cultures, which means they're going to be very good stewards. They're going to do the right thing.
They're often going to be partnerships, or structured as partnerships, or some
not a publicly traded.
Yeah, I mean, generally speaking, you'll have more success, or we've looked at that, and the numbers are better.
Right.
For when you don't have these external pressures and the profits.
It's a setup that
each year, and somebody saying, thinking of the unit as a cash cow, because running mutual funds is a cash cow business, but you don't want your owners thinking of just having that expectation.
It's good at attracting people, it's good at retaining people, but it also provides a mechanism for passing on ownership to the next generation as opposed to selling out to the highest bidder and then watching everyone flee.
So the stewardship question
Yes.
in a lot of ways.
Stewardship is very important. Really, you want to know that fund company and make sure that they are a leader in stewardship and really doing the right thing for investors.
You're buying into an organization, not just buying a fund.
Okay.
Think of it that way.
Okay. Yeah. So, John, let's talk about some firms or specific funds that you think kind of epitomize that steward role.
Well, he mentioned
PrimeCap,
Dodge & Cox. Yeah, come on, the familiar names there. American funds as well, even though they've been unpopular in recent years in terms of asset flows. They've done a great job, and their funds have still been performing well.
Tremendous stability. The analysts and managers make a career of it there.
Yeah, organizations, they can be active or passive, but organizations with long tenured employees, and it crosses over, both those. DFA is an organization that's, it's kind of hard to get DFA funds. You need to go to a DFA advisor. Right. So it's a little bit of a different path, but you want to talk about a company that was early on strategic beta, right on a lot of things, and has run their funds in a very consistent way that's been easy for people to own. That absolutely fits there. So you've got, anywhere from Vanguard representing, although that's not all they do, sort of pure traditional indexing, to strategic beta people, to active managers. And honestly, that's how we tend to think of things there is, high quality organizations with stable people offering good investments. And then you can get down to, okay, it's this kind or this kind or this kind. But that, it's really, good organization, not so good, or good, mediocre, bad is, I think that's our sorting point for thinking as investors within Morningstar.
Mm-hmm. Well, there are commonalities there that span active and passive, right? So you're talking about good stewards of shareholder capital, ones that have a direct alignment with their investors' outcomes. You're talking about low costs.
Usually good communication, so you know what it is that you're getting. You're not getting surprised.
Low turnover, which is reflective, I think, of a long time horizon, not just at the level of the individual portfolios, but at the level of the business at large as well. And that all creates low hurdles for success, be it a passive strategy, be it an active strategy.
The fundamentals are the same. I mean, even competitive advantage, which you think mostly on the active side, but it's the same as on passive, as you want costs are a competitive advantage, as well as the way the index is built. So I think all those things really do apply. And again, if you're doing a good job on identifying those fundamentals and you're investing for long term, you're going to do well either way.
Okay. We have discussed a lot of different topics. I want to thank each of you for being here today. You've all provided terrific insights. I know that our viewers have much benefited from them. So thank you so much for being here.
Thank you, Christine.
Thank you.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.